Hi, I'm Jimmy. In this video, we're looking at Huntington Ingalls, ticker symbol HII. So we're going to look quickly at their business, and then we're going to look at how their numbers shake out, what the reliability of their numbers are, and then we're going to see if we can come up with a fair value for their stock using discounted free cash flow. Ultimately, is it worth buying today? That's what we're trying to answer. Now, I actually came across Huntington Ingalls over in our private community where one of our members was telling us that this particular stock is one of the big pieces of his investment portfolio. So we're going to see how this type of company, and ultimately, is this company where it would fit into somebody's portfolio. Now, if you're interested in joining that community, I'll leave a link in the description below to our Patreon page, which is the gateway to get into that community, get into our investing Discord, and ultimately access to our weekly investing live streams. And if you do sign up, once you get over there, let me know what some of your biggest holdings are in your portfolio so we could try to break those down and see how good they are and if they're what type of portfolio they belong in. Okay, now let's jump right into Huntington Ingalls' business. So we can break their business into three primary segments. Their largest segment is called Newport News. Now, the core function of their Newport News division is that they design and construct nuclear-powered ships. Ships like aircraft carriers and submarines. And as you might have guessed, their largest customer is the US government. Now, Huntington Ingalls also does ship repairs and refueling, things along those lines, so they do have other sources of revenue, although again, most of the revenue is coming from military spending. Then, when we look at the Ingalls segment, well, this segment designs and builds non-nuclear powered ships for the US Navy, the Coast Guard, things along those lines. They build amphibious assault ships, warfare ships, surface combatants, and they're one of just a few competitors that build any ships of these types. Again, the Department of Defense is driving most of their revenue. Once again, this holds true for their smallest segment, which is their technical solutions segment. Now, this segment provides a bunch of different services to their clients, again, mostly the US government, but they offer different services and products like unmanned systems and environmental services. Sometimes the services they provide would be things along the lines of they'll team up with another company, they'll do a joint venture, and let's say there's a federal government that says, hey, here are the rules for building ships or disposing of waste. They're part of the team that helps set a lot of that up. Now, ultimately, what's interesting about Huntington Ingalls' sort of narrowly focused business model is many times I would look at this business model and I would say they really have to diversify their business. They have to diversify the lines of revenue that they have. But broadly speaking, if you're going to be hyper-focused on a single customer, having the US government is probably a great number one customer to have. And the likelihood that the United States government stops buying new ships or upgrading old ships is highly unlikely, at least for the foreseeable future. To illustrate this consistency, this is a chart of Huntington Ingalls' revenue going back to 2008. And we can see that, broadly speaking, the trend has been higher. And analyst estimates are expecting for these numbers to continue to climb higher. Now, we might say something along the lines of, Democrats just got in office. It's very unlikely that they're going to continue to spend money. They're going to put additional money in the Navy, so maybe this number doesn't go higher. But a lot of the numbers that are in these revenue projections come from the company's backlogs, or expectations of what will be completed from the company's backlogs. To illustrate, this is Huntington Ingalls' backlog going back the past 10 years or so. And we can see that, once again, fairly steady growth, which is what we would expect since we saw their revenue numbers. But to put this in even more of a cleaner perspective, this is Huntington Ingalls' revenue on the same scale as their backlog. And we can see that they have more than enough backlog to keep revenue moving higher for at least the next few years. Okay, now with that being said, let's take a quick look at our discounted free cash flow calculation to see if Huntington Ingalls' stock is worth buying today and where it could belong in a portfolio. Now, when we look at our discounted cash flow calculation, well, one thing that jumps out to me, at least right away, when I'm looking at these numbers, is the expected change from 2020 to 2021. Now, I dug a bit deeper as to why this number changed so much, or why it's expected to change so much. And there's a few changes that they made. One change is they made a change to their pension plan, or expectations around their pension plan. And when a company adjusts expectations for their pension plan, well, those numbers ultimately impact cash flow from operations cash flow from operations changes the free cash flow outlook. Now, in the case of their business, well, a lot of some of the number changes happened because of timing around their accounts payable. So let's say they get a giant bill, a couple $100 million that they've got to have to pay. If they don't pay it until the day after the quarter ends, well, this number would look much higher. So free cash flow would look deceivingly higher. So I'm not too concerned about the fact that this number is unreasonable or, unusually high. Not unreasonably high, but unusually high, because they do look like they will even out a bit. So we take those projections for free cash flow going on the next few years, discount them back to today by a required rate of return, and we get a fair value of about $361 per share. Now, this does not account for their debt, and generally it's a smart move to adjust the calculation of the entire company for the debt, just in case the company has too much debt. So when we make that adjustment, well, we get a new debt-adjusted fair value of about $324 per share. Right now, HII is trading closer to about $210 per share. So it seems that Huntington Ingalls is trading at a decent discount today and could be a very good buy. Now, over in our private community, we're doing weekly live streams where we're building different types of investment portfolios based on different risk profiles that we've created, looking at, we're building a dividend portfolio, some growth portfolios, things along those lines. This stock has a dividend of about a bit more than 2%, and it looks like it could be a good addition from a defensive perspective. If we're looking for defense in our portfolio, this could be a good addition as a defensive holding. So I'm a big fan of this company. And if we're looking to see where this stock fits in some other portfolios, perhaps more of a growth portfolio, well, I'll leave a link in the description below for how you can sign up for our community. And if you're not sure just yet, if you want to join at this point, but you want to learn more about valuing stocks, I actually did a video on how to do this calculation. How do you come up with discounted free cash flow numbers? And I built an Excel template. You can have that as well. So if you're curious, perhaps that's a good next video for you to watch. I'll leave a link right here. I'll leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.